In this video, traders, we're going to look at hard stops versus soft stops. Which is better? Stay tuned. Hey traders, warm welcome to you. So hard stops versus soft stops. What's the difference and which is better? Okay, so hard stops is pretty much what I guess most of us use as traders. If we're long in a position, we would put a sell stop in that basically says if the market goes against us, i.e. down, and it hits a certain level, we want to get out. So we have sell, stop market and stop limit, but let's keep it simple for now. Let's call it a stop market order. In other words, if the market comes down tagged to the level, let's say our stop was at 50 cents for argument's sake, market comes down, tags 50 cents, our stop order would sell the position that we put in at 50 cents or whatever it could get because it's a market order. So as soon as that price is tagged, our sell order goes into the market, it gets executed. It's a hard stop. It's resting on our machine or it's resting on our broker's servers. It's resting potentially in the exchange as well. It's somewhere where it executes and we don't have any say in it. So unless we cancel it, there's nothing we have to do for it. It just gets triggered. Now, a soft stop, on the other hand, is a level that we are looking to come out at. The level might again be 50 cents. We don't have an order anywhere. It relies on us to take us out of the market. It's basically a mind in our stop in our mind, or an alert could be. It says, hey, it's at 50 cents now. Up to you. It's up to us then to come out of it. So we might have a zone, might say, okay, between 50 cents and 45 cents. Again, I'm making these numbers up, but good for an example. And that's up to us then to come out and actually place that sell order into the market. So a soft stop won't be executed if we're not there at the screen. A hard stop will be. So you can see the difference between the two. Now, pros and cons of both. So the hard stop is you've got fixed risk. Now, not kind of adding into it things like gaps and limit moves on the commodities and overnight moves, because that would be the same for both of these things. Just assuming the market comes down and tags a level, assuming again that your size isn't massive compared to the market you're trading. But if you say we're trading a currency pair and you're trading, just any size really for retail, you're going to get out of the 1 or 2 pips. Maybe 2 pips would be pretty bad if you're on euro US dollar, but you're going to get out pretty much at the level you set. If you set a stop at, let's say you have a stop at yen at 122.50, for example, you're probably going to get out within a pip or so on yen if you're trading a reasonably small size. It's not a massive market, not a hugely fast market where the spread might be wide. So your risk is relatively quantified. Whereas in a soft stop scenario, that might not be the case. If the market runs down really quickly, a hard stop will be triggered straight away. Yes, you might get a bit of slippage, but by the time you see that, and by the time you say, hey, I've got to come out of it and then put the order in and trigger it, you may well have a lot more slippage. So there is that advantage with the hard stop. It's basically when that price is tagged, you're out. Again, allowing for those little nuances with stops. The other thing with hard stops is it's very good if you're kind of build the discipline muscles. If you're not so disciplined at the moment, or if you kind of have a weak spot with discipline, you don't have to do anything. When that level's tagged, you're taken out. The broker takes you out, the exchange takes you out, your algo takes you out, whatever it may be. You don't have to get involved. There's no action required from you to come out of the trade. Now, a soft stop requires you to actually put the order in. And if your discipline is lacking, or if you're working on discipline, or if you have kind of these vulnerabilities there, you might go, oh, I don't think I want to come out now. Let me see what happens. Let me wait. And then you could get yourself in a mess. You could be deer in headlights. The market goes way against you, and you might find you're so heavily. The market's gone so heavily against you, the trade's gone so heavily in the red that it's just too much for you, and you're kind of in that zone of, I don't know what to do now. So that's the vulnerability with that. The other thing as well, the hard stop is it's not flexible. In other words, once that stop's in, okay, yes, you can cancel it and adjust it, of course you can, but once it's in, it's in. If the market gets that level, you're out of position. That's it. Now, if we look at kind of the soft stop, really the disadvantage of the hard stop being not flexible is the advantage of the soft stop. The soft stop is, okay, if the market's coming to our level, we might have a zone where we say, I don't want the trade if it's in that level, but I will reassess it. So why might you reassess? That's the obvious question. It's like, well, surely if the market goes there, the trade's negated. Well, there are some circumstances where you want to see why the market has gone there. An example off the top of my head might be this. You're in a swing trade long in a strong stock. And this is actually something on the top of my head because it's a trade I was in recently. The market is relatively strong. okay, or the market is relatively strong and the stock is doing really, really well and it's monstering up, you've then got a level that you think, let's use this level here, where you think, you know what, I want to trail the stop up there, I want to come out and bank my profits at that point. Or it could be your initial entry, whatever. Now, a hard stop, you might say, well, my stop is there, my order's in, when it tags that, it's that. A soft stop, you might say, okay, well, if the market comes to there, I want to see, if this stock comes to this position, I want to see what the overall market's doing. Now, in this scenario, the overall market was quite weak, unusually weak on that one day, which caused this stock to kind of come down and mess around in this territory here. Hard stop would have had you out straight away. A soft stop, you might say to yourself, okay, I'm prepared to give this a bit of room because I think, or my hypothesis, whether we're right or wrong, time will tell if you're in the trade, that this was just because the market as a whole was weak and the market may well bounce now over the next few days, in which case I'm expecting this strong stock to recover from that. And I don't think it's anything to do with this stock. I think it's more to do with the market. Sure, the market could continue lower and drive the stock lower, in which case you've got to deal with that when it comes and decide where your hard stop or where your definite, get out is. But you might say, okay, I don't really want to come out of the position now because I feel the trade is still valid. This is just a bit of an anomaly, so I'm prepared to give a little bit more to test my additional thesis that that's an anomaly. So that might be why you've got a hard stop, why you've got a soft stop in there. It allows you to be a little bit more flexible. Now, of course, the downside is that if you're, I'm going to put no room for error, this is really probably this one here. If your discipline is lacking, then you could let it go lower and lower and lower, and you're still giving justifications for why you're not coming out of the trade. When in reality, the trade's just wrong. So you've got to have some discipline that says, right, that hypothesis is wrong. I need to just take it out now at some point and then close the position. So you've got no room for error at all, because if your discipline is lacking, you can see how the next day you hold it, market goes lower. Oh, it's just the market. Next day it goes lower. Oh, it's just the market. Before you know, you're giving back all your profits, or you've lost more than you expected to. So you still have to have that discipline that says, you know what, trade's not working. Let me cut it. Let me revisit it if this and this happens. Let me move on. Adapting to conditions. So this really means that sometimes we have, conditions change during the trade, right? You get like spikes that suddenly the volatility picks up a bit, and you might say, well, actually, a hard stop is almost crystallizing a loss that really the market is very choppy at the moment. It's chopping up and down. There's a lot of news coming out. Let's see your swing trading. Let's see you're trading a currency pair. There's a lot of news coming out. 1 minute it's spiking up, 200 pips, next minute it's spiking down. And we're still within an order of magnitude that's acceptable risk to you. There's no point having that stop right at those kind of extremes because you're just going to get pinged. So you might say, well, if we go to there, I'll reassess it, but look at the conditions. The conditions have changed to a very choppy, low liquidity, kind of news-driven environment. Yes, I've got to be cautious, have my discipline, that if it does go, I'm out. But I might want to just assess and say, this feels a bit spiky. This is on news. It's probably going to spike back. It has done for the past X time, so I've got a reason to accept that. And so, yeah, I'm going to hold it. And so you're not crystallizing a loss just when it touches a level. You're giving it a bit of time. You can see the danger of that, of course, but then, this is something, if you have got the discipline, then it's quite a useful thing to do. Okay, one last thing, guys, what you can do is use a hybrid of the two. So you can say, okay, at this level, let's say if we just mark that as 50 or whatever it may be, there's my soft stop area. At that point, I am going to, and imagine this is a currency pair and those are the last 2 digits or whatever, I'm going to assess the market when it gets to that. However, I have an absolute hard stop here, and let's say that's 100. Okay, so I have an assess point, a soft stop level, 50 to 100, where I'm allowed to come in. I don't really want it in this level, and in reality, that would where my hard stop would be if I was using a hard stop. However, if the market comes there, and I think genuinely, and this is the key to the soft stop, I think genuinely there's a justification for giving it a bit more room, then allow yourself the ability to give it a bit more room with the ultimate no line, red line in the sand, or line in the sand, whatever you want to call it, at that 100. So it gives you that flexibility. Now, what you don't want to do is always be holding stuff to the hard stop level, because it's going to ruin your strategy. But like I say, if the environment is like that, or in that example, you've got a justification and a reason why potentially it's come down that you think is just temporary, and it's a proper reason, not just a made up reason, then it makes sense to perhaps use that. So anyway, guys, that's hard stop versus soft stops. I think the biggest warning is watching out. If your discipline is anywhere near not up to the standards you want it to be, then go for the hard stop. If you feel you've got a good holding discipline, maybe try this and integrate this with your strategy and see how you get on. Especially, final thing, if you're looking at a strategy and you're always getting pinged out on the market, is kind of always reversing at the level you've got. Now, we always think that as a hunch as traders, but if you've got the data to back that up, then maybe you can say, okay, well, maybe I could use a soft stop and have a hard stop here and kind of see if that makes a difference to my trades going forward. Anyway, all right, guys, take care. Whatever you're doing, keep your risk managed. Bye-bye.